Let's go to Fergus, Ontario to talk to Jim. Good evening.
Yes, my question's on Viterra. What Dave thinks about their prospects, and is now a good time to step in? Thank you.
Sure. Jim, certainly Viterra is in the right neighborhood. Diversified agricultural company. Company's growing nicely. I like the business. I prefer the fertilizer companies, personally. But if you're looking for exposure to this space, this is one that you could own. It's off about $1 from the highs, which is pretty good considering the way that the market's been behaving. Most recent earnings were strong. So I have no problem owning the stock. I don't own it currently. I prefer the fertilizers, but I like exposure to this space.
Here is Ian in Prince George, BC. Hi there.
Hi, thank you very much for taking my call. Yeah, it's been a very rough month this month, and thank goodness for stop loss. But my question for you, sir, is one stock I did buy, and I did buy a lot of, is Sherritt. I picked this stock up at an average price of $4.95. I really did my research on this company, and one of the things that kind of made me attracted to them is they seem to have their fingers in all sorts of different things. Two quick questions. One, is that a good buy at $4.95? And two is, would you be able to tell me what is going on with their mines in Peru and Cuba? Thank you very much for your time, and I'll listen to your answer.
Okay. So, Ian, I want to clarify something right off the bat. There's a bunch of companies we're talking about tonight that I think are great businesses. It just may not be that they're the right businesses to be invested in this current market. And our belief is when you go through a change in market environment, you have to recognize it and be prepared to deal with it and change up the holdings in the portfolio to reflect a different reality. And this is, one of those companies, well-run business, well-diversified, gives you exposure to a bunch of different resources and power generation. The problem is it's just the wrong kind of business for the environment that we're in. If the concern is a failing recovery, then these types of companies, can really get clobbered. And when you go back and look at the 1970s, which was generally thought of as a wonderful period to be invested in commodity stocks, there were some great runs and a lot of money made, but there were about 5 corrections of greater than 40% along the way. And this is just one of those things that we're in right now. And I'm not prepared to say that this is the end of the commodities run, but we are certainly in one of those periods where, risks are being realized. So if you have a personal view and you're prepared to take the risk that this is just a mid-cycle slowdown, and it could just be that, then these stocks will do well in a recovery rally. But you have to recognize, as we talked about at the beginning, there are some binary risks out there. And if, in fact, the global recovery is stalling, then these stocks are going to continue to have a very difficult time. So I can't talk to you about specific mines. I'm not that close to it. But I just want to, say that about some of these companies. A lot of great companies we're talking about tonight. It's just a time when I think you have to be very cautious and assess how much risk you're willing to take.
And it's also a good way to look at it, as you laid it out there, from a broader perspective. A guy like Jim Rogers says we're in a multi-year, maybe 20-year or more commodity bull run, but there will be cycles, and as you say, 40% drops within that.
Well, and even Jim Rogers will tell you, he's when things are really flying, he's letting some go because you have to be more tactical in this kind of environment. If you take the S&P over the last 10 years, there's been some great rallies, but there's also been some tremendous declines. If you took $1 million and put 70% in the TSX and 30% in the S&P 500 as a Canadian investor in 2000, today you're about up about 2% a year. And that's not enough for the risks that have been taken on. Now, if you picked your spots and took advantage of some of the rallies and went to the sidelines at times, you could have significantly better results. And I just think that we are in a much more tactical environment, and you have to pick your spots. We're not bottom fishers. We prefer to see a turn first.
Right. Okay, waiting on the line now in Toronto is Luke. Hi there, Luke.
Hi, Mark. Good evening, David. Well, having said what you just said, I don't think you're going to be too thrilled to talk about this next company, but I got a question about Canadian oil sands. I've been slowly keeping my eye on it and actually established an initial position around $22, mainly for the yield, but like your clients, I do want to make money. So my question is, did I do the right thing buying now? I mean, it's only an entry position, but should I wait for it to drop? Should I go more heavily into it? And also, Mark, maybe you can address this. When I look at COS on the TSX, I only see a one-year chart. Is that because they converted from a income trust to a corporation?
Well, I'm not sure where you're getting your data from. It certainly is a continuous chart. If you went back to 2008, it was like $50.
Yeah, I'm looking at a Bloomberg here, taking it back to well into the 2000s. Maybe you just need to check out a different site, a different website to get your data.
Yeah.
Because it does go back further than a year.
Yeah, I just think that on some of these oil sands companies, there are some concerns around the costs and some operational issues. But certainly all of the very large oil producers are having a difficult time. And again, I think that you want to go to the more specialized folks that have been very successful with the drill bit. The light oil has been a little bit more attractive. But again, the energy space as a whole has been very, very difficult. And I think, again, you just need to pick your spots and wait to see things start to improve before you start adding more money to this position.
Back to agriculture now. Here is an email from Marlene on Archer Daniels Midland, ADM in New York. Is this too expensive to buy at these levels? We'll have a look at the chart here in just a second.
Right. So Archer Daniels Midland is really a processor. They get paid a fee for taking the seeds, oil seeds, and so on, and processing them into usable products that they resell. So one of the concerns is with the crop size being small, that could impact their revenues going forward. And the processors, have higher input costs. So I would prefer not to be in a processor, which is more of a price taker. I would be more like to be in a price setter, like some of the fertilizer companies.
Right, which you mentioned earlier. Short break here. We'll come back with more questions for David on North American large caps. We've got more show to go before top picks, so stick around.